Okay, Chapter 8, we're going to start talking about inventory and how we record and measure inventory. And to start out with, inventory definitionally refers to assets of a company, and those assets they would either intend to sell in the normal course of business. They also could have those in production for a future sale. And when you have that situation, you're talking about your work in process inventories that are not yet complete in a finished state, ready to sell to a particular customer. And the third one is that your types of inventory that are currently going to be used in the production of goods to be sold, and that would be your raw materials. Now, inventory typically is one of your most valuable assets listed on your balance sheet. And correspondingly, on the income statement, the account that goes with your inventory entries on the income statement would be your cost of goods sold account. And so that's the account that's going to get debited when you sell your inventory. And typically that will be the largest expense on a lot of income statements. Particularly for manufacturers of that sort. Here you see an example for Hillshire Brands Company, formerly Sara Lee, and the percentages that they had representing their inventory and their cost of goods sold. In this chapter, and also in Chapter 9, we're going to discuss the measurement and reporting issues that are involved with inventory and the related expense, like I said before, on the income statement, the cost of goods sold account. The types of inventories that we'll discuss are merchandising inventory and manufacturing inventories. Now, in a merchandising inventory situation, you have wholesale and retail companies that do not manufacture the inventory. They purchase it already in a finished form. And these types of companies will be referred to as merchandising companies. And that's typically the company type that we're going to be dealing with primarily in this textbook. Now, the cost of the merchandise inventory will include the purchase price and any other costs necessary to get the goods in the condition and location to be able to be sold. Manufacturing companies will actually produce goods that they sell, and they're going to sell these goods to either wholesalers, retailers, or it could be other manufacturers, because one manufacturing company's finished good could become a raw material for another manufacturing company. The inventory for a manufacturer consists of three components: your raw materials, your work in process, and your finished goods. Now, the raw materials, they are components that are purchased from other manufacturers, and those components will become part of the finished product that that particular manufacturer will sell. The work in process account will include raw materials used in the production and some labor that would be directly traced to those goods in process, and therefore in manufacturing or cost accounting textbooks, that's called your direct labor, because it can be directly traced to the product that's being sold. The third component of work in process is called manufacturing overhead. Now, these are costs that cannot be directly traced to the product itself. Your direct materials and your direct labor can be directly traced to the product that the company is selling. These manufacturing overhead costs, however, cannot be. And to be considered manufacturing overhead costs, they are any costs other than direct labor or direct materials that is incurred in the manufacturing setting. So some examples that we would have of these types of manufacturing overhead costs would include utility costs. in the manufacturing facility, depreciation on the manufacturing equipment, and other manufacturing costs that occur in the manufacturing facility or environment that cannot be directly linked to the specific goods that are being sold. Once the manufacturing process is completed, all of these costs that have been accumulated in work in process will be transferred to finished goods as they're ready to be sold to the customers. The manufacturing companies will generally disclose, either in a footnote or directly in the balance sheet, the dollar amounts of each of the three categories of inventory. We see an example of this in illustration 8-1 for Hillshire Brands. You'll see the levels of finished goods, work in process, and raw materials and supplies. The cost flows for a typical manufacturing company are shown in illustration 8-2. And you'll see here we have it in T account form for a manufacturing company. And you can see that the three accounts along the left, the materials, labor, and manufacturing overhead, that comprise your three components of product costs, and how those three components feed their way into the work in process account. Now, after the work is completed at the work in process stage, then the goods transfer out of work in process into finished goods. At the point that they leave the finished goods warehouse, then they will transfer out of the finished goods warehouse as they're on their way to their customer, and then be going to the income statement at that point in time to cost of goods sold. And you have some numbers down here that give descriptions of each of the transactions, whether they're on the debit or the credit side of the T accounts. A lot of this cost flow was extensively covered in ACC 205 in your cost accounting or managerial accounting classes. And you see here right below the cost flow that in this textbook, we're primarily going to focus on merchandising companies as opposed to this setting here in manufacturing companies. Again, that manufacturing company setting is primarily geared towards your cost/managerial accounting courses. The types of inventory systems that we have are a couple of types. We have the perpetual inventory system, as you see here, and then we'll also discuss the periodic inventory system. With the perpetual inventory system, the inventory account is continually adjusted for each type of change in inventory, whether that be a purchase of inventory, whether you're selling inventory, whether you are returning merchandise to the supplier, whatever the case may be. Every time you have an action that creates a transaction, you're going to continually update the inventory account for that transaction. We're going to use the Lothridge Wholesale Beverage Company in illustration 8-3 to illustrate some of these types of transactions. And in this situation for Lothridge Wholesale Beverage Company, they purchase soft drinks from producers and then sell them to retailers. They began in 2016, and they had a merchandise or I guess the company begins 2016, not that they began in 2016. They begin 2016 with merchandise inventory of $120,000 on hand. Now, during the year, they did some purchasing on account, and that inventory cost $600,000. During the year, they had sales total $820,000. The cost of those sales was $540,000. Lothridge uses a perpetual inventory system to keep track of inventory, quantities, and costs. And the system indicated that the inventory on hand at the end of the year was $180,000. So we have a few journal entries that we're going to take a look at here for their 2016 year. You see the first entry, a debit to inventory on the balance sheet, the asset account, is debited $600,000 and its corresponding credit to accounts payable, also on the balance sheet, for $600,000. That references the purchases on account at a cost of $600,000. Also in 2016, we need to record the sales and the cost of those sales. We see a debit to accounts receivable, $820,000, and that is an asset account on the balance sheet. And we have a credit to sales revenue for the same amount, and that sales revenue account is an income statement account, and it is a revenue type of account. The cost associated with those sales, as we were told up above in the paragraph, was $540,000. So our debit goes to cost of goods sold, which is an expense account on the income statement. And we credit then inventory, the asset account on the balance sheet, for the same amount, $540,000, to record the cost of the sales. Now, an important feature of this perpetual inventory system is that it is designed to keep track of our inventory quantities from their initial acquisition from the suppliers, ultimately to their sale to our customers. So the physical counts of inventory are going to have to be made anyway at the end of the fiscal year. The IRS does require a company to do that at a minimum of one time a year, and that is particularly towards the end of their fiscal year. And that will verify from that physical count that the perpetual system that they're keeping track of inventory in the accounting records is correctly tracking the quantities of the inventory. So you do your physical inventory, compare your quantities, and compare it to the quantities you have in your accounting system. Now, if there's any differences, those differences could be caused by system errors, theft, breakage, or spoilage. And we'll discuss how to deal with those at a later point in time. Now, a lot of businesses these days have software that helps them keep track of their inventory on a perpetual system. And the way that they do that is they use barcode tracking systems that scan the UTC code that is imprinted on the labels of products that are sold. And you'll see this example typically at your Walmarts when the clerks scan your product across the barcode scanner, or if you do the self-checkout, you have some experience at doing that yourself. The other type of inventory system that we need to discuss is the periodic inventory system. Now, it's not designed to track the quantity or the cost of the merchandise as transactions occur. The merchandise inventory account balance will not be adjusted as we make purchases or sales, but it will be adjusted at the end of the reporting period, as we will see here shortly. The physical count, where people actually go out and count the physical inventory there on the floor of the facility, that will determine the ending inventory, and that will help us make the entries for the costs and the quantities based on that inventory determination. Any merchandise purchases, purchase returns, purchase discounts, and freight in are recorded in temporary accounts, and we'll see how we deal with these temporary accounts at the end of the period here real shortly. The formula that helps us calculate what the cost of goods sold is under a periodic inventory system is as follows. Beginning inventory plus net purchases minus ending inventory equals cost of goods sold. And here's the acronym I often use in my classes: BI plus P minus EI equals COGS. And that's simply the letters that abbreviate that equation. The cost of goods sold equation assumes that all inventory quantities not on hand at the end of the period were sold. So with this type of system, sometimes you won't get the detail that you would like to have under a perpetual system, where you would have more control of the updated inventory quantities. Our example continues on with Lothridge Wholesale Beverage Company in illustration 8-4, and the primary difference here is that we're using a periodic inventory system, as it says here in the 5th line of the opening paragraph. You'll see the primary amounts that we need to use are in the reddish color, and the data is pretty much the same other than that periodic inventory system method being used. So we have here a first journal entry. Rather than debiting inventory, we're debiting purchases for $600,000 and crediting accounts payable. And then to record the sales, similar to what we did up above in the perpetual, a debit to accounts receivable for $820,000 and a credit to sales revenue for the same amount. Now, the cost of goods sold isn't going to be determined automatically by this periodic system. We have to wait until we do that physical inventory account in order to do the cost of goods sold, and we'll use that formula that we saw up above, BI plus P minus EI equals COGS. That will help us determine the cost of goods sold. And you see here they have the numbers that correspond in red to the paragraph in illustration 8.4. We're going to take our BI, or beginning inventory, $120,000 as mentioned there. We're going to add our purchases, $600,000, and that gives us how much in goods we have available for sale, $720,000. We're going to subtract from that number our ending inventory of $180,000, and when we subtract that, we get cost of goods sold of $540,000. Next, we see the journal entry to complete those amounts that we just calculated. You'll see that you debit cost of goods sold for $540,000 as was calculated. You'll debit the ending inventory, $180,000, for its amount. You'll credit the beginning inventory to get it out of there, of the inventory account, $120,000. And you'll credit purchases, where we initially up in 8-4 debited purchases for $600,000. Again, that's a temporary account, and we'll close that out at the end of the period. And this entry of $600,000 does that. So this is right below the journal entry. We see that this entry adjusts the inventory account to the correct period and amount by debiting the inventory account to $180,000. It closes the temporary purchases account by crediting it at $600,000. And it records the residual cost, the residual as the cost of goods sold, which is the $540,000. Now, a comparison of the two methods, the perpetual and the periodic systems, shows you that the main difference between the two is that the periodic system allocates cost of goods available for sale between ending inventory and cost of goods sold at the end of the period. You can't make that determination under the periodic until you actually go out and do your physical end of period physical inventory count. So that's the primary difference between it and the perpetual system. The perpetual system, we know whether our inventory is increasing or decreasing after every transaction and after each time goods are sold. Now, with the help of computers and electronic sales devices, such as those barcode scanners, the perpetual system is available to smaller businesses now that probably couldn't afford them earlier in their existence. So if you can do, I highly recommend, if you can do a perpetual system, that is the way to go, because you continually have an accounting system that is updating your inventory levels, which helps you manage that better than you could under a periodic system. It does say here that the periodic system is less costly to implement, but it requires a physical count before you can determine what your ending inventory and cost of goods sold are. Now, what items are included in inventory? the physical quantities included in inventory. The measurement of the inventory, the cost of goods sold, starts with determining the physical quantity of the goods. You have to go out and make a physical count of inventory. Now, in some situations, the identification of items included in inventory is more difficult than just going out and counting the physical quantity of the goods. Some of those items are when goods are in transit, when goods are on consignment, and when you have sales returns. For goods in transit, for example, when using our Lothridge Wholesale Beverage Company in December 2016, they had some goods that were shipped to a customer on December 29th of 2016. They arrived at the customer, Jabbar's warehouse, on January 3rd, 2017. And the fiscal year end for both companies is December 31 of 2016. The question is, who owns these goods at December 31st? Well, that depends on the agreement between the two companies and would be mentioned in the terms of the invoices. Now, if the terms of the agreement or on the invoice reflects the goods are shipped FOB, which stands for free on board, and its shipping point, then legal title of the goods changes hands at the point that the seller, in this case Lothridge, delivers the goods to the common carrier or trucking company, whoever is going to transfer the goods to the purchaser, in this case Jabbar. So, since it's FOB shipping point, as soon as those beverages are on the common carrier trucking company's semi, the title and the goods have transferred over to the purchaser. So Lothridge will record the sale and inventory reduction in 2016. Jabbar will record a 2016 purchase and include those goods in their 2016 ending inventory, even though they won't receive them until January 3rd, 2017. On the other hand, if the goods are shipped FOB destination, then the seller, in this case Lothridge, is responsible for shipping, and legal title doesn't pass until the goods arrive at their destination or the customer's location, in this case Jabbar. So if it's FOB destination on the invoice, then Lothridge includes the merchandise in its 2016 ending inventory, and the sale is recorded in 2017 based on the January 3rd date of 2017 that the goods arrived at Jabbar's. Jabbar will record the purchase in 2017. If goods are on consignment, then a company basically who owns the goods is arranging for another company to help it sell its product. That's a consignment arrangement. The company that owns the goods is considered the consignor or the transferor, and they will retain legal title of the goods. The consignment company who is just trying to help sell the goods is considered the consignee or the transferee. And in this situation, whenever the consignee does sell the goods for the consignor, they will remit the selling price minus their commission and approved expenses. So goods held on consignment generally are not included in the consignee's inventory and should be included in the inventory of the consignor, even though the consignor is not in physical possession of the goods. Sales returns. When the right of a return exists on a sale, the seller must be able to estimate those returns before revenue can be recognized. And we did a little bit of this in chapters 5 and 7. Now, a company should include in inventory the cost of merchandise it anticipates that it will be returned. Expenditures included in inventory. Obviously, that includes the purchase price. But there are also some other costs that should be included in the inventory account. And those would include freight charges, insurance costs incurred by the buyer while the goods are in transit, for example, if they're FOB shipping point. And generally, those insurance costs would be contained in the buyer's property and casualty insurance. There should be a clause in there that addresses goods in transit. If there isn't a clause in there and a company is buying a lot of goods that are being shipped by semi-trailer, for example, they should make sure that their insurance underwriter understands their business and have that included in their insurance contract. The cost of unloading goods is included in inventory. Unpacking them and preparing the merchandise inventory for sale. All are costs that should be included in the inventory account. All of these costs would be considered or termed product costs. Now, the freight in on purchases are added to the inventory account in the perpetual system. However, in a periodic system, the freight costs are generally contained in a temporary account called freight in or transportation in. These two types of accounts will be closed at the end of the period to cost of goods sold along with the purchases account, as we will see here shortly. So additionally, shipping charges on outgoing goods are not included in the cost of inventory. They are reported as a part of the cost of goods sold, usually among the selling expenses, because that's a selling expense to get the finished goods to the purchaser. Any type of cost associated with getting the finished goods to the purchaser is considered a selling expense. These amounts incurred during the period, as well as the income statement classification of selling expenses, should be disclosed. Any purchases returns are when a buyer returns goods to a seller, and this purchase return is then recorded. In a perpetual system, this means you will reduce your inventory account and then also the accounts payable to the seller. In a periodic system, you will use an account called purchase returns to temporarily accumulate these amounts, and at the end of the period, you will close out that purchase returns account. Purchases discounts, which we discussed in Chapter 7, can be recorded under either the gross method or the net method. Now we have an example here in illustration 8-5 with Lothridge Wholesale Beverage Company to illustrate this. We see that the repayment terms are 2% in 10 days or net amount in 30 days. And the merchandise purchased was $20,000. So Lothridge paid less the discount on October 14th, $13,720. And the remaining balance is $6,000 on November 4th. They use a periodic inventory system. On the left-hand side, we see the gross method journal entries. On October 5th, the purchase date, we debit purchases account and credit accounts payable for $20,000. They took advantage of the discount for a portion of that purchase and paid the $13,720 on October 14th. For originally costed $14,000 of merchandise. So that lowered their accounts payable by $14,000 from the initial entry. Purchase discounts gets credited for the difference, the amount of cash that they saved. And on the 4th, they paid the remaining balance of accounts payable at $6,000. Under the net method, all of the discounts are taken off initially in the first entry. And you'll see that 2% of $20,000 is $400, and that's what is taken off initially, and with the debit going to purchases and the credit going to accounts payable. And then that amount on the 14th reflects the amount paid, as we showed under the gross method, $13,720. For the portion that they didn't get to take the discount on November 4th, that difference, or $120, represents interest expense under the periodic method. So the gross method, it views the discount not taken as a cost of inventory. The net method, it represents this amount not taken, the discount not taken, as interest expense. And that discount is viewed as compensation to the seller for providing financing to the buyer. Purchase discounts under the gross method are subtracted from the purchases when determining net purchases. Under a perpetual inventory system, purchase discounts are treated as a reduction in the inventory. Now, the effect on the financial statements for this difference between the two methods usually is immaterial. In the preceding illustration that we just did here in 8-5, that $120 in discounts not taken is included as an interest expense under the net method and cost of goods sold under the gross method. And we see here in illustration 8-6 a number of transactions that compare the perpetual and periodic systems for Lothridge. And I'm getting close here. After we get through this, I'm going to publish this for the 30 minutes. So we see here all the numbers in the journal entries are in thousands. You'll see that there. So all the amounts up here that were referenced, we'll go through. In the perpetual system, let's see, this is the above transaction recorded in form according to both the perpetual and periodic inventory system. So we have periodic on the right, we have perpetual on the left. For the $600,000 that were purchased on account, we debit inventory less the discount because it says all discounts were taken. So the less $600,000 less the discount of 2% or multiplied by 98% is $588,000 debit to inventory and a credit to accounts payable. They freight charges paid by Lothridge to get the merchandise to them, $16,000. So debit inventory, $16,000, credit cash, $16,000. There was merchandise returned to the suppliers, $20,000 for credit. So we'll debit the accounts payable to the supplier, $20,000, which will lower that, and credit inventory, $20,000, which will lower that account. Then we had some sales. Sales on account for the year totaled $830,000, and the cost of those drinks sold was $550,000. So debit accounts receivable, $830,000, credit sales revenue, $830,000 on the income statement. Corresponding cost of goods sold entry is a debit, $550,000, and a credit to the inventory, $550,000. Now on the periodic system, rather than inventory being debited, we debit purchases, and we will credit the same account as under the perpetual accounts payable. Rather than debiting inventory, we're going to debit freight in for the cost of the freight. Under the returns, rather than crediting inventory, we're going to credit purchase returns. And the sales entry is the same. However, there is no entry for the cost of goods sold at this point in time, as we did in the perpetual system. To figure cost of goods sold, we have to go through a calculation shown here below. We will initially calculate our supporting schedule for cost of goods sold. And we start with our BI plus P minus EI equals our COGS. Our BI is $120,000. And then we're going to figure our net purchases. Our purchases were initially at $588,000. That's the $600,000 less the 2% discount. We had returns of $20,000, so we're going to subtract that off of our purchases because that got returned back to the supplier. Excuse me. And then we had freight in, the cost of getting the inventory to us, $16,000. So when we add those three figures, we get $584,000 net purchases. That is the P in the BI plus P. that add those two together, the BI plus P, we get our goods available for sale, and we'll subtract off our ending inventory, which we were told up above was $154,000. And when we subtract that off, we get cost of goods sold at $550,000, which you see the arrow coming back up for our journal entry, a debit of $550,000. The amounts that we will continue to debit are our ending inventory count of $154,000, and we'll debit our purchase returns to zero out that temporary account that we had credited up here in the journal entries. So that debit here will zero those purchase returns temporary account out. We will credit out our beginning inventory of $120,000. We will credit out our first entry, purchases that got debited, because it's a temporary account, $588,000, and we will credit out our initial debit of the freight cost of $16,000. That will zero out those temporary accounts. At this point, I'm going to conclude this video as part 1, and I'll pick up with part 2 shortly.